the focus today really is, there's a lot of conversation around tokenization, real world assets, institutional crypto, and invariably what a lot of this revolves around is something that we used to talk about in TradFi world, but don't really talk about that much in crypto, and this is really just fixed income. And so if there's one takeaway, at least on my side today, it's that we start having this conversation, building dialogue and community around the idea of fixed income in crypto. And so I hope to present to you today that this is very much more tangible and very much more reality than it was like a year ago when we talk about crypto from like an idealistic perspective. So just kind of keeping that in mind. Myself, just for background, my previous life was actually very early here in Singapore. I was just thinking, it's about 25 years ago, I saw my first Bloomberg screen in Hitachi Tower, just beside us here. Basically, I was visiting my brother who was on a derivatives desk back then. And everyone at his desk had PhDs, they were all physicists. And I was like, wow, these are smart people. I want to do derivatives, no idea what they were. But nonetheless, fast forward, I eventually started my career in FX options and rates and credit. Basically from late 90s until around 2012 when I left finance. But I got to work through the whole GFC period, basically led the structured credit and structured rates business at Barclays and Morgan Stanley before getting into tech. So nonetheless, I'll tell you a little bit more about Infinity, but broadly interest rates, institutional lending and borrowing, and we'll get into that very shortly. So I hope you've had your coffee. It's a Tuesday morning, but it feels like a Monday morning. And we're going to dive a little bit deep into this here. And so we're going to start with the, non-arbitrage structure of financial markets. And so this is the, there's a series of relationships between different financial products. Whether you look at it from a mathematical standpoint or an economic standpoint, where we look at the incentives between different players within the markets. But there's this structure that basically binds together, everything, all the players and all the products. And so on the on the top part of this, you have basically like your equity or FX markets. Maybe you might call them like single factor markets. On the bottom, you have fixed income, and as on the left side, there's this purplish overlay. These are the cash markets, and as you move to the right, those are derivative markets. And what we have today in crypto, from a market completeness standpoint or from a non-arbitrage perspective, really is just this idea of money and spot. FX, equity trading, we can debate that later. And of course there's futures, right? But in order to trade futures within a non-arbitrage environment, you really need interest rates. And so this, for the, again, back to the Tuesday morning thing, there's this concept called interest rate parity, and it basically binds together your spot markets with the futures prices through interest rates. And so to trade futures, you can trade them and they can exist, right? But in order to hedge out some of your risk, you need the interest rate markets to kind of lock in your P&L. So fundamentally, right now in crypto, we have basically the top part of this and not so much on the bottom. The bottom might be more OTC, right? And so the goal is to complete this map, right? Most of us are here because we believe in crypto to some degree, either at the technology level or some other ideological level. But the goal is to complete this map. And if we want to complete this map of financial products, everything really depends on, aside from money and spot, it depends on interest rates. So we need to get these right. And that's really the focus of today's conversation. Following on from that, we're not just building for crypto itself, we're building for this idea that in the future, the rails that we build in crypto, they can compete with the TradFi markets, right? And how this evolves, we will discuss a little bit. But it's a subject of debate. And so what I want to present today is basically a two-step path to get to this point, right? How can these markets compete face to face? And so the first one is basically tokenized treasuries. And so tokenization is not something new, right? It's been around for a number of years, but most of it has been in more like equity tokenization, for example, right? Like I might tokenize Tesla stock, and that fractionalizes the Tesla, and I can potentially distribute it to more participants in the marketplace. But I'd argue it's really incremental in some sense. There's other questions around tokenization within TradFi, but none of that will ever see its way into kind of these open markets that we operate in. And tokenization in respect of TradFi, for example, JP Morgan, doing $1 billion in some period of time, I equate this to basically them using one type of database and then upgrading to another type of database. It's not exactly that, but there's maybe 10 layers of intermediation or just within these institutions. It's really just eliminating one of these layers. And so there's that aspect of tokenization, but more importantly, it's very difficult for a lot of these banks to tokenize in the way that we think in crypto, simply from a capital perspective, from a capital adequacy. Maybe we can dive into this a little bit later. But broadly speaking, tokenization of treasuries is the first and most important point. What this does is that right now, these two ecosystems, they operate largely independently from one another. You'd have your TradFi system, you'd have your crypto ecosystem. The Fed might raise interest rates and Bitcoin might react, but there's no logical binding between these two ecosystems. What happens when you tokenize treasuries is that we're now bringing an asset from that fiat world into the crypto world. And now that I have a tokenized treasury, if I can trade that instrument versus stablecoins or versus interest rates within the stablecoin world, now these two worlds compete head-to-head using digital technology. And that's basically the first step here. So if I can bring these treasuries on-chain, let's say I have for argument's sake, like a 5-year treasury. I bring that 5-year treasury on-chain, I bring it to infinity. I can now borrow stablecoins at some rate. I can maybe borrow stablecoins at 3.5%. And there's an arbitrage, or there's some variance between stablecoin interest rates and treasuries. Might be higher or lower, but in this case here, I can buy a treasury, tokenize it, and bring it on chain, borrow at 3.5%. I can off-ramp that back into fiat, and I can basically arbitrage through this. And that effectively logically binds these markets together. And so this is how we bootstrap a stablecoin or a synthetic dollar yield curve into the crypto markets. And this is powerful, right? This is what we're all working towards. And so what we need, we have the beginnings of that with guys like Ondo in the US and a few others, but they're tokenized money market funds. It starts this conversation around bringing yield on chain. But again, once we start tokenizing treasury bonds themselves and bringing duration on chain, then we start building a yield curve. And at that point, all of this becomes much, much more tangible, right? We fill in interest rates. Now we can trade 5 times more futures because I can trade the derivative contract, I can trade the actual cash market, longer dated options, all this other stuff, credit, interest rate swaps, and everything else. It now exists in a pure financial theoretical form. So just 2 bits on ourselves. So we're basically institutional rates, lending and borrowing. We're not live yet. I'll show you a little bit about the interface. Our team are mostly from TradFi as well, or TradFi backgrounds. We're about 23 people. We're largely based in Hong Kong, although we have people in LA and London as well. Some great investors as well around us. I wasn't going to flip to the actual experience. I'll just show some screenshots. But basically, this is what you see. Basically, your blue chip tokens, it's a yield curve. So I can lend and borrow at a floating rate or a fixed rate. And this is for digital assets. And so this is something that we kind of dream of in crypto, but it's going to be a reality very soon. This is kind of like your basic experience. I just see your yield curve and I can lend or borrow. But for your more institutional trader, this is kind of the interface. We also have full WebSocket and REST API as well. It's basically like that TradFi or CFI-like experience, but it's for rates. And within the TradFi world, there's basically like your interbank market, your interbank lending or secured lending and borrowing between financial market participants. It's very much an OTC market. But just due to the nature of digital assets being global, we can now unify this into a single exchange interface. So this is it. Happy to talk more about this a little bit later. 2 venues, basically one is a permissioned entity, one is permissionless. I won't dive too deep into this. Multiple use cases. Again, this is just interest rates. It has universal use cases across real money accounts, fast money, different participants on the institutional side, on the retail side. There's guys who sit on both sides, market makers, hedge funds, exchanges, and a whole bunch of others. And that's it. We can kind of dive into this a little bit more, but I basically just want to provide this background to articulate that fixed income in crypto, it's far more tangible, it's far more real. And so with no further ado, we will now discuss it a little bit more.
Good morning, everyone. Very good to meet everyone. I'll see a lot of familiar faces as well. It's just a quick one on myself. So I'm a fourth-time entrepreneur. Not everyone knows as such. Spent time on the hedge fund side, essentially on the macro side, and used to trade derivatives essentially. So all the three co-founders of Wintermute are ex-Optiva, and I used to basically the first thing I did in trading and very much intrapreneur such as part of Optiva was to build a desk to arb rates essentially and listen to central bankers and try to understand how that would impact the curve across 2, 5, 10 years or so. What TradFi people call the long end essentially, vastly between very much Europe and the US. And through that, it probably gave me a more sort of qualitative and quantitative, background into looking at prices as such. After that, my first firm in London in 2011 was essentially a macro hedge fund of a family office as such, very much trading rates as well. And I spent a lot of time on the venture side, so on the opposite side of the spectrum in terms of duration of the trade, I would say, like the 15-year trade as opposed to the weekly trade. And I find I ended up going into crypto because I found that it was quite interesting to see the merge of these two worlds. So I could see the qualitative size of like the startup world and very early stage projects being listed, and the trading experience basically all merged into one ecosystem. So finally, after saying no to blockchain as such, or to Bitcoin more at the time in 2012 and 2015, I ended up saying yes in 2017 actually through an extra ways. So again, people who overlap macro and the TradFi world and the world of ICOs at the time. So we're now nearly 6.5 years old as such as Wintermute, and we've grown to become essentially the largest spot crypto market maker. And we have a small team becoming bigger, but a small MIT team of 15 people in Singapore, mostly covering very much derivatives. Quite keen to see how the space evolves around derivatives, and I think Kevin really flagged that. Very importantly, is that the missing pieces of interest rate, missing pieces of just simply for us to just get a forward to be able to trade, options beyond, let's say, a 3-month sort of duration is actually quite challenging. So we end up building our own curves as such, but then things do get a lot more liquid and so on, with a lot more price discovery as we have other people to interact with. So we trade about 26 or 27 underlyings or so these days. That means BTC and ETH that you can see on your screen. So as some of you trade on maybe on Deribit or some other exchanges. We trade many more underlyings as such, and I just I think it's pretty easy to say that we could really help make those markets be a lot more efficient as such. We also cover ventures and so on, so happy to discuss that with some of you later. But just pleased to be here, and then let's get going.
I think one of the things that I was interested when I met Kevin, the thing that was sitting in the back of my mind about the space is, you have your crypto natives that have a very good understanding of what it is that you're trying to build. And at some level, there will be a level of adoption that moves towards supporting what it is that you're looking to build. If you look at sort of a step beyond that, the demand and the adoption from conventional business for fixed income products. So whether it's corporates wanting to essentially use stable coins to do payments, and instead of having to move from stable coins into fiat, having a stable coin treasury, and then essentially having treasury-based products for them. Do you see the early stages of that sort of taking place to sort of introduce liquidity into the fixed income space? And can you maybe just share your thoughts on, from an adoption perspective, where you see that is currently, and where you see that likely to go over the next few months and years?
Sure. So I think you're getting at really what is that step-by-step evolution in the types of trading behaviors or activity that we would see that ultimately catalyze that full financial market. There's different parts to it. The first part is really, well, one is setting up the infrastructure, the technical infrastructure for market completeness, and this comes back to what Yo was saying on the futures side. If we can create that third leg of the spot futures and interest rates, and that already natively will invariably attract players who can basically arbitrage those futures rates versus the spot rates. So you can trade kind of these three back and forth. We need to do some work with margining across between us and centralized venues where you can do this. But effectively, once we do that, that brings liquidity naturally to the interest rate market. There's guys like Yo as well as many others who naturally trade this and will sit on either side of it. But I think that's one of the first layers of it. The next, and I guess be going long and short kind of on both sides. But there's other guys, for example, let's just take on the ETH side. There's ETH staking, and that staking rate is a floating rate. And that's fine from maybe like a retail perspective, but then when you get to the institutional side, you need to lock in your rates. So how can I, whether the term is swap or change that effective ETH rate from a floating rate to a fixed rate, that's a natural evolution. So basically through us, you could achieve synthetic fixed rate staking effectively on our protocol. And from that, there's just your natural kind of lenders and borrowers, right? There's a lot of them are currently lending within a floating rate context. How can I lock in that so I can forecast my cash flows more easily? But we do see this, I guess, evolution, one from once the technology is in place, having the market makers to sit on either side of the market. There's guys who would want to not have just floating rates, they'd want to swap for fixed rates. And at that point, you start building the confidence around now extending that curve out even further. Once that curve extends out even further, then you can basically help like long-term ETH validators or long-term Bitcoin miners, those guys who borrow in dollars but basically earn native in those other currencies, they can then swap those proceeds back into dollars. So I see that kind of the evolution over the next couple of years, but ultimately it comes back to the liquidity, right? And so us engaging with guys like Yo and other market makers to bring a pocket of relatively deeper pockets to this market. And so that's what we're excited for.
Yeah, just to talk on that just at a higher level, I think the theme is the convergence of both worlds, and it's really what we saw. I think there's one, it's usually mentioned as more institutionalization of the space. That was my pitch to VCs in 2017, we're just raising as such, and just to see the next wave of growth as such. But genuinely, it's a merge of both worlds. So you get a better and better match. And I'll give a caveat to that later. But essentially, you get a better match of the crypto native ecosystem has gone through what some of you have embraced and some of you have missed, and it is the DeFi summer as such. So everyone was just starving for yield, and you go through a whole DeFi summer where just through more Ponzinomics than generally tokenomics, but essentially there's people were starving for yield essentially, especially in the summer 2020, which led a whole lot of money. I mean, from the macro side, it was essentially money printing at the state level, March, Q1, Q2 of 2020, and then you get all that money flowing into the crypto ecosystem. So there's been after DeFi summer, people have been generally starving for yield in the crypto ecosystem in general, especially after the failures of the Celsius and BlockFi and so on of the world, which had a nascent forming of interest rates in just slightly longer durations, and it fell for other reasons, not because the pricing was wrong, but probably because the risk appetite was just too high on their side clearly, and other problems of fraud and so on. But luckily we passed through that, and then it's all a rite of passage, as some would say. So that's one thing. There's a desire for just genuine yield from the crypto native ecosystem. I think there's also a better and better overlap of traditional finance going into, and then very much the sell side in that case, just trying to find new assets and new things to pitch to their customers, to be quite honest, and it makes a ton of sense, and it's very much what brings more price discovery into the space. the essential pieces of interest rate is there just to get the basic layer, the ground to really be able to build many products on top. But essentially, it's like the ideal world is the world I used to trade in was interest rates, where you have a whole ecosystem of structured products that get pitched to I don't know, an industrial customer at a bank. The desk at the bank needs to hedge and ends up with people like us, trading through vanilla options, and then you get a whole ecosystem of price discovery. And the background of this, and in terms of a lot of these structured products, that keep in mind that usually you need to be able to see 1 or 2 years ahead to be able to actually just build enough premium, as we call it, so enough optional value in it for everyone to make some money out of it. And it's one really of the key pieces. So I think it's quite an interesting time to be in the space where there's a good merger of these both needs on the traditional finance side and then the crypto side for finding out. And yeah, DeFi now has to compete with interest rates all the way with a 5.5% yielding treasury, as opposed to negative yields where we had before. The caveat to that is that let's give it into the context of the last 3-4 days in crypto, is that when things fly up, no one cares about yield. and that's the slight caveat, and from the crypto native community, but I'm pretty sure we'll have you need the yield in between, and you need things to be polished. So there will be a bit of a balancing act from the crypto community about how misguided or how much people, as we say, that will be aping into some coins and potentially even some meme coins, and balancing this with more ground strategies and in that case more the real world assets coming into the space.
Yeah. So just one more point. I think it's really the maturation of the market, right? You have most of the activity is really speculative in nature, right? And so as it comes to those long-term lenders and borrowers, like what are they doing with their cash? And you really can't do much with it, right? And so as we build out those longer dated curves, hopefully we can go beyond just 1 or 2 years. And as I mentioned, when we bring your 5-year treasury on chain, then in some sense, the ecosystem doesn't need to care in some sense about ETH and Bitcoin. We have the dollar, the stablecoin kind of foundation, right? And so what are those things that we do in the dollar world? And we can now do those in the crypto world, right? On top of that, obviously I care about Bitcoin and ETH, but it's more that now it can operate on its own and independently, and it reaches that institutional stage.
So one of the things that sort of fascinates me as you're talking through this is going back to the tragic events of last year. A lot of adoption also is a function of trust from a marketplace perspective. So, I mean, Yoann, you've built a business that faces many counterparties on a daily basis, and trust is a significant sort of element. How have you gone about sort of building the trust? Because ultimately, again, there were many fixed income projects that didn't succeed in the past. What do you see as being critical factors for those fixed income sort of opportunities to be successful?
Yeah, so I mean, we build a business very much based on trust. So we're very, very brand driven as such, and we just, the big theme is us being, finally over the next few years, whenever that will happen, being perceived as builders, as who we are before being traders as such. I use a bit of the Google example, where people think of Google as a tech firm, not as an advertising firm, but they make money from advertising. We happen to make money from trading, but we build products as such. We build technology. That's one thing. So more being clear about the culture, being clear about the relationship you want to have with, especially with counterparties as such. We have a bit more than 1,000 counterparties these days. So that means we trade OTC with all of them. It's the question of I think durability and surviving many cycles is one thing. You can see that in the crypto exchange world, where it's more about surviving than anything. Probably in the market making world as well. But in terms of, I think it's just about finding the right balance of information sharing. You want to share enough to build trust, but you don't like too much information also happens. On the sort of the centralized finance versus DeFi in terms of how to manage trust in terms of especially the very crypto natives would actually sort of would tend to value DeFi more in the way that okay you can trust a smart contract versus sort of trusting a counterparty. The challenge you have there is that actually reality is like not many people can actually go and read through a smart contract and do this analysis themselves. So I think you end up with a system which is a bit hybrid, which what we've seen in terms of lending platforms that have worked in the DeFi ecosystem, where you end up with a semi-permissioned pool essentially, where maybe the lenders the lending is permissionless, but the borrowing ends up being permissioned with people like us who just have to show balance sheets and so on and have to get a certain kind of credit score. And I think we'll end up with sort of a very much hybrid world. I think you mentioned in your setup you both have permissioned and permissionless pool, and I think it's a bit of the way these worlds converge is finding the best of both worlds essentially. So post FTX, I was very much like thinking, it will just show that DeFi rules and then it's failure of decentralization. Sadly, I think what we all have to respect is I keep on tracking DeFi users as a percentage of total crypto users, and it just sticks to like 1.4, 1.5%. And it goes with the rest of the space, and it just like somehow like people are not really able to crack, better DeFi adoption per se. And I think it's just because CeFi or even traditional finance and so on, essentially the centralized models are very much there they do the onboarding. Most people actually learn about crypto in the first place through a centralized exchange and not really through DeFi as such. So I think we need to balance these two acts, and it's all about trust building as you mentioned, and it's more about we'll see what form that takes.
If I might add, I think there's, as you mentioned, the trust on the DeFi side. I could potentially read the code, but actually can I read the code is something else, right? So there's trust on the DeFi side, and there's trust on the CeFi side with the institution. But I think on the CeFi side, it also comes down to like credit risk as well. And so in the spot markets, what is the credit risk from trading spot? I can transfer tokens into Binance, I can go long, short, and I can remove those tokens, within a moment, or maybe a handful of blocks, right? But if in the interest rate space, interest rates are far more capital intense in that sense, that I'm lending or borrowing I'm lending for 2 years or 3 years. My capital is actually locked up within that institution. So how do I manage that credit risk? Am I okay with that centralized counterparty's credit risk? Or do we have some type of off-exchange settlement? Do we have a custodian who can safeguard those assets? And so on our side, we need to give comfort not just from our processes and our transparency, as you mentioned, not too much transparency, but we need to have that trust with the market, not just on that perspective, but the credit risk element as well. So for us, working with the custodians, and basically trying to move those assets effectively off our balance sheet into a tripartite collateral management agreement that effectively can help mitigate that counterparty risk away from us, and then we're just a trading venue at the end of the day.
In the market maturing and for the convergence to become a reality, tokenization going forward is going to play a significant role, particularly tokenization of real-world assets. Where do you, from a maturity perspective, and there's a lot of activity taking place, people building tokenization engines, people looking at cross-chain tokenization, so forth and so forth. From a maturity perspective, where do you see the tokenization markets? Do you think that they're mature enough to get to a point where that convergence is imminent? Or do you still see it being some time away?
I think it depends. I think let's put it that way. There's the sort of two models that the more open model, sort of a la Ondo and so on, where it suits a hybrid user base as such. You have there's three cases. There's one that's very DeFi native that has lost a bit of TVL and so on, and that's just much more keen on that will actually switch around, as I mentioned earlier. And as a caveat is that they won't necessarily just go and build total value locked as such. but there'll be more the switching between lending and just aping into meme coins. There's a whole range of new participants like the Franklin Templeton and so on who just run their own infrastructure. I don't know where Standard Chartered is there, so I don't necessarily want to put you in a bad spot there. But that's one of the safest routes in a way that you can just use your own customer base and you run things internally. You don't have any issues with the regulator and so on because it's just you use the whole framework that you normally use, and it's just about having a different tech and a different backend essentially. I can see that growing quite a lot. It's sort of stuck around the 4 or 5 billion or so as far as I know these days, but that's the easy route. For me, is real, especially RWA in general. There's two things. There's giving access to existing products to new people. That's one thing, but it's also giving access to new products to existing customers or new customers. And the comparison of that is obviously giving existing product access to new people could be very much access to treasuries and just a much better yield. Or I like to take a picture when I land in Singapore of the HSBC. So I'll just talk about a competitor there. The HSBC, hold of liquidity that you see when you land in Singapore. It has been sponsored by me receiving 0.5% interest on my savings account when HSBC is getting about 5% or 6% or whatever the bond was yielding at the time. So okay, that's a decent spread. So there's this gap. There's some element of disintermediation or simply just a bit more fairness about just on savings rate. But there's a completely different set of use cases where you end up with things like you're taking a Grab or an Uber or so, and then you have a world where you could actually just you have a very good experience with the driver and you could literally just finance them. So that's the sort of things that you can unlock. And I like to use the Uber comparison where Uber, when they raised the seed round in 2008, they thought their market, like the TAM was essentially 2 billion, and they ended up with a decade-old level valuation. That's actually a good reason because they opened a new market. And there's similar elements that we hope to see in RWA where, to give the example of backing your own Uber driver, but essentially you can end up with use cases like this. So this is path to growth in the space.
In terms of what on the tokenization side, I think it matters like what are you tokenizing and why. As Yo mentioned, is it kind of are you broadening distribution, right? And that's tokenizing, say, equities or some asset that otherwise wasn't as accessible. But ultimately it comes to we have, especially within the credit markets and kind of the shadow banking community, you have like 12 intermediaries between the person who lends and the person that borrows coming back to your HSBC rates, right? And so, that's evolved through a passage of time. And so can we get to, not having 12 intermediaries, but can we have 2 or 3, some less amount? That's really the goal here, right? And so to the extent that we can start to bring those real world assets, for example, even like houses, mortgages, cars, student loans, all those assets on chain, then what's to stop like me from providing financing on that? I can technically provide financing so long as I can mitigate credit risk. And so if I can, regulation is one thing, right? We need rules for this, but there's nothing to stop me from a technical level from providing financing on a mortgage so I can basically offset that credit risk somewhere else in the market. And we're getting very close to doing that. So again, it depends what and when and how the regs are evolving as well.